Hi, welcome to this video on investment appraisal. I do quite a lot of these, and I'm hoping that you'll find this one useful. There's plenty of notes on this, and the spreadsheet I'm going to use and the notes that go with it are all on this spreadsheet. They're on these tabs down, the cover sheet, the notes, quite a lot of stuff here. This spreadsheet is downloadable from this site here, along with this video. No charge. Okay. Investment appraisal is simply putting it in a nutshell, is assessing whether in fact money spent on a project is actually going to yield proper return, a profit, if you like. And in a simple little world, you may say, well, I spent $100 on something, and in, say, 11 years, I get $10 a year, and that means I got $110. Well, no, it's not going to be as simple as that. One of the problems is money tends to lose its value if it doesn't earn anything in the way of interest. So it's very important that we bring into the cost, or what's called the cost of capital, into what we think is going to be future cash flows. Try and explain it as I go through it. But more on this. There are notes here which go into some detail about the process we're going to use. What we're going to look at is a question here where a company, a fictitious company, of course, has an investment proposal of putting in $600,000 in this case. And here are the future income flows. And it's just a 5-year project, say. That's it. Okay. Now, as I'm going to develop more videos on this, they'll get a lot more sophisticated as my series goes on. But anyway, we've got 10% cost of capital. This is going to have quite an impact. So what we're going to do is work out the net present value. What are these income streams worth in today's money, given that we've got 10%? You see, there is an opportunity cost. You can either put your 600,000 into, say, a bond or government securities, or some kind of just some kind of investment of some sort. In other words, let somebody else do it and they pay you an interest on it, or you can put it into your own project. That's what we're trying to do. Is it worth it? And we've set 10%. So the opportunity cost of that may be, say, 6%. Okay. Now, obviously, this is very objective. The subjective side is to actually consider the prospects about, for example, the marketing aspects of it, the sort of external factors of a business, and so on. Anyway, we're going to look at this idea of net present value, and also look at what's called payback. Well, as I say, I'm going to keep it as simple as I can, as it's an introduction. So what I'm going to do is start off looking at the cash flows. So I'm going to start with the year naught. Seems a rather odd thing to do, I know, but I want that to be the outflow of this money. I'm multiplying that by -1. And you can see the purpose of me using the spreadsheet is that you can go in and change that figure. So you can do a lot of what if scenarios. What if it was a different amount? What if the cash flows were different, etc. So by the end of year one, we've got 150,000. So I'll just equal that figure. Okay. And year 2, 3, 4, and 5. So I'll just replicate that down. So here's all my cash inflows here. And if it's negative, it's a cash outflow. So give it a heading. That's the cash flow. Make sure we know what we're doing. Now, this is the only technical bit. Discount factor. Now, I'm actually going to use a formula here. Normally, if you're under examination conditions, often they would give you this discount factor, sometimes called DCF, abbreviated. But I'm going to imagine you've got $1. I'm not using currency symbol here. You'll see why. And at the end of the year, at 10%, it's going to be worth, in today's money, not $1. So I want to think about that. All right. So that money is going to lose its value over the years at today's rate, at what's called the net present value. And what we do is we discount that. The 1, I'm going to divide that by 1, and then 1 plus this figure here. Okay. In other words, that money is going to be worth around about 91 cents at today's. That's all it's going to buy equivalent today. So what we're saying is that you wait a year, it's only going to be valued at today's money, 91 cents. Now, you can see the formula in there. Unless you're not an expert on spreadsheets, I won't go into that in great detail, but I'm going to replicate this all the way down. And we can see that each year, that $1 is worth less and less and less. Okay, so what I'm going to do is I'll display this to a number of decimal places. So that's plenty. 4 is plenty in any examination scenario. But as it's a computer, it'll in the background, it's going to work to multiple decimal places. Okay, so what's this worth at today's money? Well, let's multiply these two together. Okay, so what I'm going to do now is I'm actually going to work that to the nearest whole dollar. So it's still worth $600,000 because it's just started. Let me just copy that down. So you see, $150,000 in a year's time is only worth $136,364 now. So that's what we call the net present value. So the income stream here, when we apply the discount factor, this is what it's really worth. So if I add up all those figures together, we've now got the actual value of the investment, and we need a positive figure. Okay, and we've got one. Okay, that's pretty good. It's not bad. With that income stream, well, let's just add up the actual absolute values of this, not taking into account. It looks like we've got 650,000 net. All right, that's taken into account the 6,000 negative. So it looks like we've doubled our money, but we haven't really in real terms. So on the basis of that, that might be okay. Okay, now, sure, we all hear media reports that projects never end up costing what we think they're going to cost, so it might cost more. And remember, there may be some outflows during the year. As I said, more developed problems I'll deal with in much later videos. So what do we call this? Well, we call this the net present value, NPV. That's it. So on the basis of that, we got a project that actually might pay. Okay. Well, what about the so-called payback? When we we actually claw back all that money? What we do is we work out what's called a cumulative cash flow. Okay, now it's going to be based upon real money, but in year 0, we're 600,000 down. But in the next year, in real terms, we've clawed back this amount of money, 463. We're now clawed back that money, so our real outgo so far has been 463,636. So let's do that again. So we're down on this amount. So we've now got this coming in. So gradually, we're clawing back the money. What are we looking for? We're actually looking for the number 0. And here it is. It's somewhere in there, isn't it? It's somewhere between 3 years and 4 years. Well, again, on a future video, it's only introduction, but where you can see that around about halfway through year 3 and 4, we might get all our money back. So the so-called payback period is 3.5 years. A lot of companies prefer using payback as opposed to net present value because the sooner they get their money back, often it's implied there's less risk. It might explain why so many governments want stable economic environment, stable interest rates, stable everything, so that there's less risk to these investments. And often unstable economies, when you invest in it, they're looking for very, very short payback periods. And that often means short-term little projects all over the place rather than long-term, for example, large infrastructure projects. Well, just an added point. Okay, well, there we have it on that. It does say evaluate whether the investment is worthwhile. Well, certainly on the basis of net present value, and providing this is a real figure and it stays like that, if the interest rate goes down, let's see what happens. Then the return is even more. So this is where the subjective judgment is needed. Is the company's cost of capital stable or not? And that largely, you know, what I just mentioned before, is partly dependent on the sort of economic environment that you're working in. Okay, so which is why you've got central banks like the Fed Reserve very, very keen to promote the idea of stability in the markets. So, is it worthwhile? Yep, if that's what you think you're working in a fairly stable environment. And certainly when I'm doing this video, I would say that's pretty good. I can't see interest rates going above 10%, much above 10%, or cost of capital much above 10% now. Okay, but some smaller businesses, you know, they might get charged more than that. Repeat the process using a cost of capital twice the above. Well, there you go. Still just about worthwhile. So let's double it again. So that's pretty good. All right. What's the internal rate of capital? Well, what you do there is really simple. What number here, right? What number in this yellow box could be set to make this figure equal 0? Okay, now spreadsheets can do that, very simple. But we'll do it the clumsy way. And we've already said 20% gave us a positive return. So 40% gave us a negative return. So using some form of iterative process, we home in on what we think. So 30 is no good. So let's try 20. 25. So it's about somewhere between 25 and 30. There it is. We're gradually getting there. So let's try 25.5, being a bit. So we tried 25, didn't we? 26 gave us a negative figure. 20. So that's just me. I'm just playing around, and that's the fun you can have with these things. Okay. Right. Well, you're going to get a figure of just over 25. I think we've established that. So 26% is, to the nearest percentage, is your internal rate of return. Okay. As I say, if I've got some future videos which I'm going to do this a little bit more detail, a little bit more sophisticated as we go through. Okay. Thanks for watching. Happy studying.